When doing creative finance deals, does price matter? The answer is yes and possibly no. It all depends. On this video, I'm going to break it down for you coming up.
The Real Estate Funding Kit is out now. Learn how to get 100% funding for all your deals without dealing with the banks. Claim your free copy at myfundingkit.com.
My name's Jerry Norton. I've been doing real estate now full-time for 20 years. I make millions of dollars a year wholesaling and flipping houses, and one of my strategies I do quite often is creative financing. And on this video, I want to talk about price, because there's this idea out there that price doesn't matter when doing creative finance deals. And there is some truth to that, but in most cases, that's not true at all. So let's talk about it. Why does price matter? And why should we be buying at a discounted price? Okay, so I'm a fundamentalist. I was brought up in real estate where you always get a deal. A deal is defined as equity. So if you think about it, if I'm gonna look at a deal right now, and let's say that today's value on a property is $300,000. That's what it's worth as it sits right now today. So if that's the case, and that's the value today, where am I acquiring that deal? If I pay $300,000, I'm paying full retail, full price for the value of the property. Now, the hope is that whenever we acquire property, that in time, the value of that property will go up. And traditionally speaking, that's been the case with real estate. If you look at the 200-year historical trends, real estate continually goes up. Now, it doesn't go up incrementally and consistently. Usually it goes like this. It's more like a roller coaster trending up. So the reason why it's so important that we consider price is because we have to weather the storms. We have to weather the up and down. And so when it comes to real estate, there's a direct correlation between equity and liquidity. Liquidity. Now, what is liquidity? In real estate, the way that we play safe is that we're always able to exit out of properties if we need to. If the market takes a dump, something happens in our life where we need cash very quickly, there's another problem going on over here, we want our real estate to be as liquid as possible. Now, it's not truly liquid because it takes time to sell the property, find a buyer, close, and get your cash out. But for the most part, we want to stay as liquid as we possibly can. We want to be able to exit out of deals if we ever need to. So let's take a scenario here. Let's say that this property's got a value of $300,000 today, but let's say that I acquire the property at $280,000. So what does that mean? It means that on paper, I have $20,000 in equity. That's my equity because I'm buying it for $280,000, it's worth $300,000. That $20,000 in equity is now buffer. It's a little bit of wiggle room. If I need to sell the property, ideally I can sell it, get made whole on my capital investment, and get my cash back out. Now that's a little tight there. So let's say that we acquire this property at $250,000, and we have $50,000 in equity. Now, because it's worth $300,000 today, I'm buying it for $250,000. Well, if the market does a dip and it dips down, and now I lose out on that spread, do I have enough room where I could exit the property quickly and get my cash back out of the deal? That's why it's important to have liquidity. It's all about that liquidity because we don't know. We cannot predict the future. And history tells us that markets go down, they come up, but they go down, they come up. And so what are you going to do if that happens? If you don't have equity in a property, you've removed your buffer zone for dealing with the unforeseens, for dealing with the downturns, for dealing with the problems that may arise. Maybe that property ends up not working out how you thought, and it's not cash flowing, or it's not doing the thing you intended it to do. Can you sell it and sell it quickly and get your money back out of the deal? Especially if you have debt. So if I have debt on this deal and my debt is $280,000 on the property, it's worth $300,000, and then the market dips to $250,000, I'm now upside down. It's only worth $250,000, but I owe $280,000. So if I want to sell that property, I've got to come to the table with $30,000 in cash to get out of the deal. I don't want to put myself in that situation as much as possible. Now, the hope is that it does this. The hope is that let's say in 5 years or 8 years or how many ever years, it appreciates at 6 or 8% annually or whatever. And we're going to hope that in time, this property goes from my value today to a future value of $400,000. And if that's the case and that happens, it's fantastic. It's amazing. It's like, wow, I got into this deal at $300, now it's worth $400. I just gained appreciation. I just gained $100,000 in value because the value of that property appreciated in time due to the market trending up. And we can hope for that. It's amazing when that happens. I saw that happen quite a bit with a bunch of properties I had during the COVID boom, right? Where we saw 20, 30% appreciation. It was amazing, super fun. I've also weathered through 2008 where everything tanked and went the other way. It lost 30% or more, right? Like I've been in those ups and downs. So if I'm gonna acquire property and I'm gonna hold assets, it's very wise to buy at a discount. It's very wise to create as much equity as you can. The more equity, the more safe you are in the deal. When is there a situation where we might bypass equity, where we can get into a property with zero equity or even negative equity? Is there a situation where that might make sense? It only makes sense. There's only one scenario where that makes sense. And that's if the terms of that creative finance deal far outweigh the equity in that deal. Okay, now I'm gonna give a scenario here. Let me ask you guys a question. Let's say that I can acquire a property right now today and the value of that property is $100,000. Let's say that I set up a creative finance terms to buy that deal for $1 million. It's worth $100,000 today, that's the value today, but I'm gonna buy it on creative finance for $1 million. Now, when would that make any sense at all? If all I'm looking at is price, that is a horrible idea because I'm so far off of the value. But when would this be a scenario? Well, let's say that the terms, tell me if you agree with this, tell me if you like this. Let's say that my terms are a 100-year loan. So I have 100 years to pay it off. And there's no balloon, like there's no due date. I got a full 100 years. And let's say that my payment on this loan is $100 a month. I don't know what that would amortize out, but let's just say whatever that amortizes. Let's say that my loan payment to the seller on creative finance, seller finance, is $100 a month. And let's say that this property I can rent for $2,500 a month is today's market rate. So my payoff amount in 100 years is $1 million, but I only have to pay $100 a month from now for 100 years, no balloon or anything. And I can rent this property right now today for $2,500. Is that a deal that I would consider doing? Yes, I would consider doing that deal. Price no longer matters. Price is irrelevant. Why? Because the terms far outweigh the price. Because I have 100 years to pay it off, and it's only $100 a month, and I'm gonna cash flow $2,400 for 100 years or more as it goes up, right? So that scenario, I would probably get into that deal. That would make sense to me. So when you're looking at creative finance, it's never just one thing. This is where people get confused about creative finance. It is a number of things. What are all the things that we're gonna look at? Of course, we're gonna look at price. Price matters, but only in context to everything else. We're gonna look at the interest rate. That's gonna matter, the interest rate. We're gonna look at if there's a balloon or a payoff time. How long do we have to pay off the loan? That's gonna matter. We're gonna look at the entry fee. Entry fee is the down payment that the seller is wanting, plus closing fees, if there's any commissions, an assignment fee to a wholesaler. What's the cash needed to get into the deal? That's our entry fee. That matters, right? We're gonna get into cash flow. What's the cash flow? From my total payment to the rent I collect minus operating cost, how much am I making monthly in cash flow? That's a factor that I want to consider. I want to consider my tax benefit. By owning this property, how does that benefit my taxes? Do I get the depreciation write-off? What's my cash on cash return for the amount of money and my entry fee versus what I'm getting in return? In other words, what's my ROI? There's like 10 different things that go into a creative finance deal that will make it a deal or not a deal. And everybody's got a different value in these different areas of a deal. So for example, I wholesaled a creative finance deal at the end of the year. It was December something, and the buyer that was buying it was an investor, and they were buying it mostly for the tax benefit. They needed that property for the write-off that they could get for the year, and that was their primary concern. Now, did these other things matter? Yeah, they mattered, but not as much. Other people, it's all about the cash flow. If this thing's not cash flowing $500 or $1,000 a month, then they're not interested in the deal. Other people, the entry fees are a really big deal. They want to get into these deals for little to no money down. As long as it's little to no money down, they'll compromise in cash flow. Some people look at the interest rate and the balloon. If I can get into a 2.99% rate fixed on a 30-year with no balloon, I'm okay to maybe negative cash flow $100 a month, because in time I'll pay down the loan, in time it will hopefully appreciate, or rents will increase, and I'm willing to take that risk, right? So everybody kind of looks and gives different weight to these different areas of structuring a deal. But if you just isolate price alone without considering other benefits, then I'm a big believer in acquiring deals at a discount. I always want to try to buy at a discount. For one, I know how, and I've been taught to. I'm an investor. My job is to get good deals. I want to build in right out of the gate, right before I even done anything to the asset. I want to have equity in that deal. I want to be able to sell it quickly and not just get my money back, but ideally have room to make a profit. And that's what we do as real estate investors. Nothing drives me crazy more than to watch people completely eliminate price, meaning they pay full price or overprice, and then they structure okay terms. Not great, okay. And they get into these creative finance deals, but they're not great deals. They don't have room to weather the storm. As soon as something happens, they're in trouble. If they have a furnace that goes out, a tenant that wrecks the place, doesn't pay rent, or whatever else is going on, a balloon comes due and they don't have enough room to get a new loan and pay off the investors, like all these things that can come into play are what can get you into trouble with creative finance. So what I did is I created a creative finance calculator. And it's a very simple calculator. You basically input the data. You put in there, okay, here's what the rate is, here's if there's a balloon, here's what the total entry fee would be, here's what my cash flow is based on my revenue from short-term or long-term rentals, here's the tax benefit I can expect, here's what my cash-on-cash return is. It goes through all of these different things, and then you get to manipulate the numbers. You get to say, okay, well, you know, if I pay full price, does this deal pencil? Is this still a good deal? Not really, because my terms aren't that great. So I can't be paying full price. I need to get a discount on price to offset something else that's not going on. Or maybe you're like, man, I got a 2.99 interest rate, but they want a 1-year balloon. Well, that's not really gonna work for me, because in 1 year I gotta pay this off, and I don't know if I'm gonna be in a position where I can pay this off in a year. I need more time. So the interest rate's fantastic, but the balloon is terrible. So, okay, I gotta go back and restructure this. I gotta get a 5-year balloon or a 7-year balloon or no balloon or whatever. My cash flow, my cash flow on this is $200 a month, but if I pay less in price and I renegotiate my interest rate with my seller, well, man, now I can get my cash flow to come out at $400 a month. I'm just spitballing here, guys, but what I'm doing is I'm manipulating the numbers until I've got what I believe is a solid deal with built-in room for error. I don't want to hold assets. I don't want to do real estate unless I've got room for the unknowns. I've got the ability to weather if the market goes down, if rents go down, if something happens to the property and I got to put more cash in. Am I in a position I can handle that downturn, right? Like that's the way I want to look at this when it comes to real estate. So guys, I'll give you my calculator for free. I'll put the link in the description below this video where you can download that for free. And finally, guys, the last thing that I want you to do is I want you to watch another video where I show how to structure these creative finance deals so that you can wholesale them for big profits. Because you don't have to just do creative finance to keep. You can very easily pass those off to other investors. You can wholesale creative finance deals and make a premium doing so. If you can put together a great structure on a creative finance deal and it checks the boxes, right? Like it's got the things. If it's missing something, it makes up for it somewhere else, but it's a good deal overall looking at all things, then there is a buyer that would love to buy that deal, add that to their portfolio. And so you can then assign that deal, structure it, put the deal together, format it, right? So you got all the terms and everything agreed upon with a seller, take that packaged up creative finance deal and wholesale that to another investor. Let them buy it, let them come in and take over that deal, and you make an assignment fee. So I teach how to do that at a high level. I want you to watch a video right here where I break down and show you how to put those deals together, and I'll see you on the next video.